Have you ever wondered if backtesting is truly reliable? Why do some traders swear by it while others dismiss it as ineffective? What if both sides are correct? The answer lies in understanding perspective. By asking the right questions, we can uncover the strengths and limitations of backtesting and apply it more effectively. Let's start with a fundamental question. Does backtesting on higher timeframes produce better results? From a price action perspective, backtesting on the weekly, W1, or daily, D1, charts can provide realistic insights into market behavior. Why? Because these timeframes smooth out the noise and highlight significant trends and levels. Can we then use this information on lower timeframes like the H4 or H1 to identify candle patterns and precise entries? Absolutely. If you've identified a key level on the D1 chart, wouldn't it make sense to look for confirmation on the H4 or H1? Now, consider the alternative. What about mathematical backtesting? Using algorithms to overlay outputs on charts might seem like a more scientific approach. But here's a question. Are these solutions truly comprehensive? They often rely on a single data point from each candle, be it the close, open, high, or low. If price charts are non-linear, as we know they are, wouldn't this create limitations in the data's accuracy? Another question arises when examining lower timeframes. Can mathematical models handle the increased noise and market sensitivity on charts like H1 or below? Events like economic announcements heavily influence these timeframes. So, does this noise distort the back-tested outputs? The answer is yes, and it's a crucial consideration for traders relying on mathematical solutions. So, what's the takeaway? Isn't it clear that both approaches, price action-focused and mathematical, offer value but require context? For those favoring price action, isn't it logical to start with higher timeframes to establish a foundation before drilling down to lower timeframes for entry points? And for those using mathematical backtesting, doesn't it make sense to account for the limitations posed by noise and the nonlinear nature of price movements? By approaching backtesting with the right perspective, one that acknowledges both its potential and its limitations, traders can make more informed decisions. Isn't that the ultimate goal? Written by David and Roxy, Where Logic Meets Imagination. LTRFXC/substack.com